Good afternoon, ladies and gentlemen. My name is Michalis, and I am the markets analyst here at HF Markets, and I'd like to welcome everybody to another webinar. Today's webinar is extremely important. It's a very unique webinar because it is what we find is the bracket where most individuals are interested and want to learn. So we've got different areas and different types of traders. We of course have traders which have absolutely no clue what the trend is. They don't know how the price is derived, they don't know what the price is, they don't know what a trend is. And then we have other individuals who have experience, they're more advanced individuals, and they want to start looking at more advanced aspects of the market, such as order flow, such as the volume weighted average price, and so on and so forth. Today we're looking at where most traders are actually, and it's that middle bracket, ladies and gentlemen. It's when individuals are able to look at the price and say, okay, yes, the price is in a trend. We are looking at a bullish trend. We are looking at a bearish trend. I understand what kind of trend we are looking at in the market, but they're not able to take that knowledge a little bit further, a step forward, to be able to say, yes, this is a trend at the moment, but this is going to be the next price movement. So today's webinar, yes, we are going to spend just one or two very quick slides where we're going to look at the basics of trends just for any individuals who have never traded before. But 90% of the webinar is going to go through step by step what steps individuals can take to go from that scenario where you're saying, this is the trend, but I don't know what's going to happen next, to go from that scenario and actually go a big step ahead and say, yes, this is the trend, and I know that this is going to happen within the market. So this is what we're going to look at as part of today's webinar. This is what today's educational session is going to be based on. Before we get started at looking at what is a trend, the basics of a trend, and like I said, what 90% of the webinar is going to be based on, where we're going through those steps to be able to identify the next price movement, which is the most important thing as part of today's webinar. Before we start to look at those pages, I very quickly want to do an introduction. Now, as part of this slide, I want to mention two things. Number one, here at HFM, we are dealing with investments, and you have full control over your investment. So we have no control over whether you are speculating that the price is going to increase or if it's going to decrease, or if you're looking to hedge, or you're going to look at different market conditions. You have full control over your investment. And of course, it is an investment. We have no control over the price movement. And of course, you can go on Google, you can type in the NASDAQ and look at the price of the NASDAQ, and you will see the price movement is the exact same as the derivative. So the derivative is mimicking the price movement of the real asset. So this is why I say we have no control over it. And we have no control over whether you're speculating an increase or decrease. So you have to understand it is an investment. You have full control over that. And it's important to understand the benefits and the risks of the investment before considering and moving to a full investment. The second thing I wanted to mention, ladies and gentlemen, is of course this webinar is not here to give investment advice, but what we do want to do is to give you as much educational knowledge as possible in order for you to be able to make informed decisions, to be able to be active in the financial trading markets with knowledge, with expertise, and with confidence. This is what, of course, we want to do. So this webinar, ladies and gentlemen, is here for educational purposes. And it's also a great opportunity because, yes, it's a presentation like you're going to be looking at now, but at the same time, it's not just a presentation. You have the opportunity to ask as many questions as you like. So, for example, we get a lot of individuals who says, this is a scenario that I saw today. What is it that I can potentially do to improve that scenario? Maybe somebody has specific questions about something particularly happening within the market. It's a great opportunity where you can ask questions directly. And of course, after you ask questions, you can, I will answer the questions live on the webinar. This is the last slide that we're going to look at before moving to looking at the basics of a trend, which we're only going to look at over 2 slides. Now, this slide is not important to your trading. It's not going to be educational. It's not going to make you a successful trader. But I do think it is important to know a bit about the individual who's providing you with this information. So, ladies and gentlemen, my name is Michalis. The main thing I want people to understand about this slide is to feel comfortable to ask as many questions as you like. I have been in the financial trading markets for 10 years, so it's been quite a long time now. I've been trading and investing for 10 years as well. I originally started off as a financial advisor in London, in the UK. That I did for just over 4 years, and I've been a market analyst now for almost 6 years. So I've been in the financial trading market for 10 years. So the reason why I'm saying this is just so you know a little bit about my background, and of course I want individuals to feel they are able to ask questions and of course get accurate answers. Now, why trade the trend? Like I said, I don't really want to go and spend too much time looking at step by step what is the characteristics of a trend, because it's not going to make you a successful trader. That is the truth, the ugly truth. We get a lot of educators online that look at certain things within the market. We'll look at the very basics as well. Like a lot of people look at higher highs and higher lows, and they look at breakouts and so on and so forth. It's not going to make you a successful trader. Somebody who's sitting there in Barclays and HSBC and he's trading, he's not looking at higher highs and higher lows. It's not that simple. But what you can do is take certain steps, real institutional way and analysis of evaluating the price in order to make sure you are able to determine the next price movement. But it's not going to be as simple as higher highs and higher lows, like the load of garbage which people are educating on YouTube. So, but what I do want people to do and understand as part of this slide is why trade the trend. I'm actually going to look at one of the recent trends within the market, a current trend within the market. I chose yesterday to write down the USA 100. Of course, I did write this down before the US inflation release, in which case we saw a very large pullback. But nonetheless, it's a 12-day trend, so that it's a very long-term trend. You can even look at a larger time frame, in which case you would see that the Nasdaq has been trending now for over 2 years. But nonetheless, we're going to look at the latest impulse wave. So if we look at the latest trend within the Nasdaq, which was from the 1st of February to the 12th of February, I measured the price movements against the trend, and I measured the price movements in favor of the trend. Now, the price movements in favor of the trend, I'll get my highlights out so everybody can follow me. The price movements against the trend, sorry, in favor of the trend, is an upward trend. The price movement in favor of the upward trend is 8.8%. 8.8% just within only 12 days. Now, the price movement against the trend, ladies and gentlemen, was 4.4. Okay, so think about it in this way, ladies and gentlemen. Let's say we got a dice. A dice has 6 sides. Now, if on 4 of the sides, or should we say on 5 of the sides, we have the number 1, and only on one side we have the number 2, and I roll the dice, are you going to say, I want to be betting or speculating, whatever it may be? I want to be speculating that the dice is going to fall on the number 1, or that the dice is going to fall on the number 2. Of course, you're going to choose the number 1. Why? Because 5 of those sides have the number 1, and only one side has the number 2. Now, I speak to a lot of individuals who are repeatedly looking at certain strategies where they say, you know, I'm looking at the Nasdaq is too expensive. Nobody's going to be willing to purchase that price. It's the highest price it ever has been. It's increased in value over the past 2.5 years by an X amount, which is more than it ever has increased at a faster pace. So nobody's going to be willing to buy, and it's going to collapse. And ladies and gentlemen, I'm not saying it's not going to collapse. It may at some point, of course. No trend will continue forever and ever. At one point, it is going to collapse and then regain again. But it doesn't necessarily mean you instantly go onto the chart and start speculating against the trend. Now, there's a lot of strategies, such as the martingale strategy, such as the Kafka strategy, which is also known as trying to catch a falling knife. Okay, which is basically when the price is dropping, we say it was in an upward trend, it's dropped, so now we should be buying because it's a cheaper price, and then it drops again, and we say let's buy again because now it's definitely too expensive, sorry, too cheap, and then it drops again, and you say, okay, I'm going to open one last trade to speculate it increasing because now it's the cheapest it has been in over a month. What actually keeps happening is the trade just keeps moving against you, and then you've got 4, 5, 8 different trades at different prices, all speculating one direction of the market, but you actually are seeing the price moving in a completely opposite direction, and that puts you in a very difficult position and can either wipe out a large percentage of your account or a certain percentage or your whole account, and that's not something that we want to be following. So we have a lot of individuals who say, you know, the trend is going to end, let me speculate against the trend. And of course, the trend at some point is going to end, but a lot of people get into bad habits of it's at this price, so I think it's too expensive, so I'm just going to sell straight away without any other signal, nothing to back anything saying that yes, it is too expensive, or not necessarily that yes, it is too expensive. That's not good enough to say it is too expensive and it will drop today. Because if it's going to drop in 2 months' time, while you're speculating it declining, for 2 months the price is increasing in value and moving against your trades, which is of course something you want to avoid. And I wanted to show you a real example. So this is a very good example. Would you rather be speculating in the direction of almost 9%? Or speculating in the direction of not even 4.5%. Okay, so this is something that you need to consider. All right, this is the reason why today we are looking at how to take advantage of the trend. Analysts also advise that trading in the direction of the trend is easier for beginners. Okay, so we need to get out of the bad habits of let's speculate against the trend. Okay, it's more easy to identify a reoccurring trend and continue in that reoccurring trend rather than trying to pinpoint the exact point where the trend's going to end. Okay, and it is mathematically proven, because if we look at point number 1 again, okay, we look at the mathematics of each and every trend, most of the price movement is in the direction of the trend. So why try and benefit from the smaller price movements when you could be benefiting from the larger price movements? Okay, it's very simple. It's like, for example, if I take 2 balls, one ball is a football, the other ball is a golf ball, and I put it 500 yards in front of you, you won't be able to see the golf ball. You will be able to see the football. Why? Because it is larger. Okay, and the same thing applies to when you're looking at a trend. This is why a lot of people say that beginners have more advantages when looking at the trend. Now, the most difficult aspect of the trend for beginners is having the discipline to exit when the price moves against you. Do not forget that a trend lasts longer. Do not forget a trend lasts longer. So if you are moving against the trend, of course, there's a higher risk to that. So, for example, ladies and gentlemen, the biggest danger for individuals trading the trend is that when a new trend forms, okay, so let's say we're trading this trend and we've opened 10 trades, okay, all of them are profiting, we've closed them all, but let's say we open an 11th trade here and then a new trend forms. What actually a lot of people do is they don't close the trade, okay, whereas you open this trade, you should have said to yourself, okay, I opened the trade, it's an incorrect trade, the market's moved against me, so I'm going to exit the trade here. Okay, and then I've got 10 trades, which each trade maybe I may be earning, for example, $50, and on that 11th trade I've lost $50, but I'm still in a profit because I've identified a new trend has formed. And instead of trying to speculate against the trend, why not try and take advantage of this new trend? Okay, a lot of individuals, they open a trade, the market moves against them, a different trend forms, and they don't try and take advantage of that new trend, but they wait for the new trend to end to start moving back in their favor of an old trade that they opened. Why not try and take advantage of the new trend? Okay, so this is what I'm trying to refer to here on point number 4. Point number 3. Point number 4. It is important for traders to understand what is driving the trend as well as indicators. So keep in mind, we have to look at fundamentals as well as technical analysis as well. Though today's webinar is largely going to be looking at technical analysis. The last thing is a trend is always going to be formed by impulse waves and corrective waves. And I'm going to give you some examples as well. This is the last 2 slides now that we're going to be looking at as part of the basics. This is the NASDAQ. This is recent price movement on the NASDAQ, ladies and gentlemen. This was actually the trend which I referred to you in the previous slide. So we can see here that I said there was just under 4.5% against the trend and almost 9% in favor of the trend. It's this price movement here, so you can very clearly see the upward trend. So it's a lot easier to take advantage of the price movement upwards rather than these smaller price movements like this, because if you don't enter these price movements perfectly, then of course the price is going to quickly move against you. Okay, and that's not something that you want to happen. You'd rather trade in favor of the trend, and if your entry wasn't correct, let's say you're entering, for example, let's say you enter here at this point in the market here. So on this star, I enter a buy, and I speculate the price is going to increase. It wasn't a good entry. It was a terrible entry. The price actually moved against me throughout most of the day. Okay, it's not an issue. It's not an issue in any way, shape, or form. Why? Because I'm trading in the direction of the trend. So my mistake is easily going to be forgiven. Okay, and you can see the next day, not only I go to a break even, but actually only the next day go into a profit. The day after that is a higher profit. The day after that is an even higher profit. Okay, so this is why I say it's easier. Okay, there's still risk. I'm not saying there's not risk, but it's easier to analyze and find opportunity in the direction of the trend rather than trying to find opportunity against the trend. So a traditional trend, bullish trend. Now, the thing that we of course need to mention, again, I mentioned this at the beginning, that what I'm going to mention now is going to make you no money, okay? But it's something that individuals who have never traded before need to understand, okay? So for example, when we look at a trend, when we look at bullish trends, you have to look at the lows, okay? So this is a low. This is the next low. So it's kind of, you'll see it's waves. We're looking at the low level of the wave. You see, this is the next low, 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 and this is the next low. What do we notice about this, ladies and gentlemen? You'll notice that each low is at a higher price, okay? Then we've got the wave highs, okay? So we've got a high here, we have a high here as well, we have a high here, we have a high here, and we also have a high here as well. What you notice again, we have higher highs. So in order to have a bullish trend, we have to have higher highs and higher lows, okay? If it's going to officially be a trend. If we get higher highs, but the lows are at the same level, so for example, we may get a high, a higher high, and an even higher high, but the price starts looking like this, in which case the lows are at the same level. Even though the highs are higher, the lows are at the same level. So it's not a trend, okay? That's, for example, what is known as an ascending triangle. Then we're looking at a downward trend. We're going to go for the exact same thing. Low, 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 low. We've got highs, we have highs, high, high, and highs, okay? Each occasion they're lower, so this is a trend. Now again, like I mentioned, that's not going to make you any money, ladies and gentlemen. But what we're going to do now is we're going to go step by step, okay, there's a few steps, so please bear with me. We're going to go step by step at looking at how to look at the market and not say we're in an upward trend, but to say, yes, we're in an upward trend, but this is going to be the next move, okay? Because if I go back, ladies and gentlemen, and we look at, let's say, this downward trend, let's get rid of the writing here. So for example, this is the price movement of, okay, so this is a very short-term time frame. It's only a 1 minute time frame. It's the pound against the Japanese yen. Because of course we have to take into consideration some individuals are ultra short-term traders. Keep in mind, these steps can be taken no matter if you're an ultra short-term trader like a scalper, or you're more medium-term like a day trader, swing trader, or if you're a longer-term trader. You really have to take into consideration if CFDs are ideal for you, because of course there's overnight fees. Now, it's not about looking at this and saying it's a downward trend, so I can make money, because I'm able to identify that this is a downward trend, because that is past price movement. There's nothing to say to you that yes, it's a downward trend, but it's going to continue. The trick is not being able to say that this is the trend. That will make you no money. What you need to be able to do is say, okay, yes, this is the trend, but this is going to be the next price movement. And this is, we're going to look at steps to look at potentially how you are able to identify this, because that's going to be the difference between somebody who is unsuccessful or somebody who's finding some success is 50-50 to somebody who's consecutively and successfully able to open trades. Okay, this is what we need to do. So for example, we want to look at the price and say, you know, we're looking at this type of price movement like this, but as I'm here, I'm able to determine that the next price movement is going to do this to this price. Okay, this is what we need to determine before the price movement happens, to say this price movement is going to happen and it's going to go to this price. Okay, because when you're able to do that, then you're able to plan the next trade. Okay, now of course, keep in mind, ladies and gentlemen, I'm not going to be able to say to you, you know, these are the steps to potentially identify that the price is going to go to $101.91 at this specific time. But what we are able to say is that potentially it's going to go to this bracket here at this certain time. Okay, so we're going to do that, we're going to look at we're going to look at price action and indicators. We're going to start off with the indicators though, because it's very easy to understand. So here we have two indicators. We've got a red line here. Now this red line is a 75 bar exponential moving average. It's very easy to find on your MT5. You go to the top left to insert, indicators, trend, moving average, and you'll see there's an option there to input the period. The period is 75 bars, and you're choosing the exponential method. Okay, so it's an exponential moving average on the 75 period, and it will appear on your screen like a line like this. And then here at the bottom, ladies and gentlemen, I have what is known as a relative strength index. Now the relative strength index is made up of 4 zones. So we have above the 75, so above this zone here. Now if we're above the 75, either at 75 or above it, it is indicating the price is too expensive. Now if the price is too expensive, it may lose momentum, so it just starts to move sideways, in which case we can't make any money from that. It may retrace, in which case we don't want to try and trade the trend at a retracement. So for example, you know, this here, ladies and gentlemen, is an upward trend. Okay, I want to of course enter here and speculate upwards, but I don't want to enter here and speculate upwards. I'd rather enter at this point. Why? Because here there's a retracement. I don't want to enter where the price is going to start moving against me. Why would I want to? Okay, I want to enter where the price is going to start moving in my favor. So this is what over 75 is indicating. It's indicating the price is too expensive. So it could lose momentum, it could retrace, or we could see a completely different trend. Okay, that's also possible. Now the next thing, ladies and gentlemen, Keep in mind also that the RSI, because somebody just asked a question, so I'll answer it now. The RSI, the period, can be anything between 18 to 20. So you can click a period of on the RSI for 18, 19, or 20. It's completely down to you. This one is on 20. Now, the next area of the RSI is between 75 and 50. Now, this is indicating to us that buyers have controlled the market. So what we're trying to do on this setup here is identify whether buyers are controlling the market or whether sellers are controlling the market, and we're trying to identify the bias for the price movement. Okay, so if we're between 50 and 75, it's an indication that buyers are controlling the market. Okay, of course we want to trade and speculate upward price movement when buyers are controlling. We want to speculate a downward price movement where sellers are controlling. And then we have between 50 and 25, which is this region here. Between 50 and 25, ladies and gentlemen, we have an indication sellers are controlling the market. If we're below 25, so this region, it means the price is too cheap. And there's a possibility again of a complete change in trend, a loss of momentum, or slight retracement. Okay, so again, we don't speculate in that area of the market based on these steps anyway. Keep in mind, this is a 2-hour time frame. If you're going to follow this, it's important that we're looking at a 75 bar exponential moving average, the RSI, and both of them on a 2-hour time frame. You can find the 2-hour time frame very simply by right-clicking, clicking on time frames, clicking on more, and it'll show you 2 hours there. Now, what do we want to do? Of course, we want to identify upward price movement and downward price movement. But what we want to do first is identify when buyers are controlling the market and when sellers are controlling the market. Now, it's important to understand if buyers are controlling the market, they're not going to always continuously control the market. So it will change, but it will say to you that you've got some time period now where buyers are controlling the market, where you can take advantage of upward price movement. Now, if the price is trading above the 75 bar EMA, and here the RSI is trading between the 25 and 75, in which case it does between here all the way up to here, and it does again between here all the way up to yesterday, because this is a chart from yesterday. So there was only a slight period where we had a couple of hours where it dropped below the RSI, and we didn't have an indication there. But nonetheless, if we look at this period here, and of course the price needs to be above the 75 bar EMA, in which case you can see here it crosses above. Now here, ladies and gentlemen, we can see if we're following this, we were successfully able to identify buyers are controlling the market. Look at this upward price movement here, ladies and gentlemen. Very clear upward price movement, which is indicating buyers are controlling the market and the price is going to increase. Okay, doesn't mean the price only is going to increase. We can see it decreases here, it decreases here as well. It lost momentum here and it lost momentum here. Nonetheless, upward trend, a lot of upward price movement. Anybody who kept hold of upward trades, even if the entry was poor, even if you entered here, which is a poor entry, you still would have been in a profit very, very soon, and quite a large profit as well. Now, if we look at a down example, so a bearish price movement, we can see here as well. So here we crossed below the 75 bar, and we also crossed below the 50 on the RSI, but not below the 25. So here we had the indication of downward price movement. Since then, of course, we got downward price movement. Okay. Now, the only thing that we need to slightly be cautious of is a lot of the time, every time we cross the moving average, so we crossed here, 90% of the time it will move back to this line before continuing the trend. Okay, so we have to be cautious of that. Every time it crosses over, it could retrace back downwards, back to that trend line. So for example, yesterday it crossed below the trend line because of high RSIs, higher inflation rates, But you will notice this morning it just went straight back up to that trend line. Okay, and we saw the same scenario happened here as well. That is something that you will see again and again and again. Now, some people will avoid the first crossover and wait for it to stabilize above, or they can trade that second impulse wave like this, or what they will do is very simply wait out this price movement here. Okay, any reason is absolutely fine as long as you're following the next steps as well. I've got another question, so let's look at how. Okay, so very easy question. How do I display the RSI on my chart? On the MT5, go to Insert, go to Indicators, go to Oscillators, and you'll see Relative Strength Index. If you click Relative Strength Index, it will appear exactly like you can see it on my chart now. So this is the first thing though, ladies and gentlemen. We're going to input onto the chart the moving average, 75 bars, and the RSI. If it's above both, we want to look at where there's opportunity to speculate upward price movement. If it's below both, we want to look at opportunity where to speculate downward price movement. This is another example, okay? So we can see now I'm looking at a completely different asset. We're looking at oil, 2-hour time frame, okay? We can see here we're above the sentiment line, so this moving average. We're also above the RSI as well, above the 50, and look at this massive upward price movement, okay? Like I said, when it comes down to this red line here, a lot of the time it will cross over. If it crosses over, a lot of the time it will correct back to that downward price movement before continuing to trade downwards. And you can see it does continue to trade downwards. But if we follow this setup, even on oil, which is a very volatile asset, it gave us accurate, great indications here, gave us accurate, great indications here, and it gave us accurate, great indications here as well. Okay, it's a very, very easy setup. We're above the moving average, above the 50 on the RSI. We look where there's opportunity to speculate upwards. If we're below, we look at where there's opportunity to speculate downwards. Now, this is going to help us identify the trend. Okay, identify the trend at the moment, identify if the trend's going to continue, but it's not going to say to us the price will go to here. Okay, it will go to this bracket. So over the next couple of days, the price is going to go between $80 and $83. It's not going to tell us that. Okay, so this is what we're going to start to look at as step number 2. What we're going to do is we're going to measure the traditional waves. Okay, it's very important. I said this on last week as well. People went absolutely crazy over this. People loved this. People said, I've never done that before, and it worked so well. So I'm going to keep on mentioning it for more people to learn it, and until people get it into their heads. You have to measure the price movement. You have to always measure the price movement. The only thing I will say is if you get an untraditional price movement, something which is going to happen only once in a month, you can ignore that price movement and not include it as part of your calculations. Now, I'm going to use the worst assets possibly to do this, the most difficult asset. Okay, why? Because it's very volatile and keeps having untraditional price movements. Okay, I'm looking at here at oil. Now, what I'm going to do is, like I said, when we look at trends, there's 2 types of price movements like this. So you get these upward price movements like this, and we get these downward price movements. Now, I'm going to measure both separately, but both all of the upward price movements and all of the downward price movements, and I'm going to input them on to my MT5. Some people prefer to write it in an Excel. Some people I saw were writing it on a notepad. It's completely up to you, because we do some one-on-one sessions as well, and I saw what people were doing. Now, why is this important? Okay, because you're able to identify the traditional price movements of the asset. Okay, and I'll show you exactly how you can use this to determine what type of price movement is going to happen next, as long as you've already identified the trend. Don't forget, here we've identified the trend. Now we're going to identify the next price movement. Where can it potentially go? So I've measured all the price movement. I measured this price movement, it measured 2.65. Then I measured this price movement, it measured 2.05. I measured the next price movement, measured 1.35. I measured the next price movement here, 1.20. This price movement was 4%. I'm going to ignore that price movement because it's once every month it's going to happen. And then I've measured all retracements. So I've measured this price movement, which was 122, this price movement 144, this price movement 75, 71, this price movement was 1.13, this price movement was just under 1%, this price movement was 0.75%. Okay, so what have I done next? I've taken a note of the smallest wave. Okay, so the smallest upward price movement was 1.20. The smallest downward price movement was 1.71. Then I've looked at the largest. The largest was 2.65. Keep in mind, I'm ignoring this price movement because it's very untraditional to see such a large price movement. And the smallest upward price movement I saw was 1.44. You will notice that 1.44 and you'll notice 2.65 is much larger than 1.20 because we're looking at an upward trend here with oil. So I've mentioned the largest, the smallest for both types of price movements, and then I've done the average. Okay, how do we work out the average? Very similar, very simple. I add all of these price movements like this, I add them up, and I can see the 6. So I've added it up and then divided it by 6. Very simple. So the average for the downward price movement is 1%. The average for the upward price movement is 1.81. So when I see an impulse wave like this, and I see upward price movement, I know that we're getting close to an area now where we're likely to see some kind of price movement against me. Okay, how do I know that? Because if I measure between here all the way up to here, okay, it's measuring 1.40. Okay, and I know the smallest upward price movement that I've seen is 1.40. So I know here we get into an area where really I'm starting to become in danger of the price moving against me. And I know on average the price will go up to here, and the very max, if we're going to follow traditional price movements, the price is going to go up to here. So as I've traded this price movement, even before I've got to that area, I know I need to consider exiting. Why? Because in this region here, okay, we're going to see the price do something like this. Even if it's going to continue upwards after that, it's going to retrace. So I want to exit, avoid the retracement, and then if the trend is going to continue upwards, let's enter at a better price. Okay, because don't forget, when the price declines, it just very simply gives you an advantage, the option to enter at a better price. And then, ladies and gentlemen, we get the next price movement. So we said to ourselves, the price moved upwards. I exited because I didn't want to endanger myself and risk the retracement, and the retracement starts to fall. What do I do next? Okay, I know that on average the retracement is 1%. I know the largest retracement is 1.4. I know the smallest is 0.71. So I know even before the retracement happens, look here, we've only had a very, very tiny price movement. The retracement's only just started, but I already know that it potentially can go to here, here, or here. So the largest, the smallest, or the average. Okay. Some people say the most important is the average, whereas a lot of people say if you want to be risk averse and try and avoid risk, then if this is your area, try and exit just before the area. Okay, or try and stay to yourself, just before that area. You need to consider if it's going to happen. But let's avoid that. Let's ignore that just for the moment. Okay, because that's slightly going a bit more advanced. So I know this is the area, so I know it's going to do something like this. And if the trend is going to continue, and we're going to start to look at indicators for that, I know that the next wave will go to here, here, or here. Okay, so I know it's either going to go up to the smallest wave, the average wave, or the largest wave. So this area here is my target. Okay, so I've got another question. So somebody says, why are we using a 2-hour time frame? We're using a 2-hour time frame to identify the trend in the medium term and to identify if buyers or sellers are controlling the market. If we're above the trend line, if we're above the RSI 50, then buyers are controlling. If we're below, sellers are controlling. So we need to take step by step. The next step, ladies and gentlemen, is the crossovers. Now we're looking at a 5-minute chart and we're looking at crossovers. Now every time there is a crossover, it's indicating that there's enough momentum in one direction of the market for you to quickly speculate the price movement. So let's look at crossovers. Okay, this here is a crossover. So you can see the yellow crosses below the red. So at that exact price, okay, there's no point doing it 10, 20, 30, 50 minutes later. There's no point saying it crossed over up here, so I'm going to speculate down here that it's going to decline. No, it's too late. You have to wait for the next crossover. So it's saying that at this price, at that exact time, there's a chance the price is going to decline. Okay, and as you can see here, the price did decline. Let's look at another crossover. Look at this crossover here. So you can see the yellow crosses above the red. Okay, and you can see at that point there's an opportunity, and indeed the price does indeed increase. Let's look at the first one here on the left. So if we look at here, the yellow crossed downwards. Okay, and so it's saying at this exact price here, there's an opportunity for the price to decline. Okay, so it's very, very clear. Crossovers. This is how it's known. Now, what crossovers am I using? I'm using an 8-bar exponential moving average, and I'm using a 17-bar simple moving average. Okay, those two. So the red that you can see on the screen is an 17-bar simple moving average, and the yellow is an 8-bar exponential moving average. So let's start putting these together step by step. How am I able to determine the next trend? Because using these 3 things, the sentiment line, RSI, the crossovers, and measuring the impulse wave, I'm able to identify the next price movement. Okay, now of course it's not always going to be accurate, but the point is to have high accuracy. And even if it's not always accurate, as you get more experience, ladies and gentlemen, you will be able to see and identify where there's false indications. For example, last week we had a webinar, it's on YouTube now, where we looked at false breakouts. So how to identify these false trends in the market. But that's a different webinar. You can go on YouTube and look at that later on if you wish. So here is an example. Step number 1. This is the US dollar against Japanese yen. Very popular asset to be trading because you have a very strong currency against a very weak currency. Also, they're both safe haven assets, in which case one of them is going to be in demand. Not both of them is going to be in demand. So it's a lot of the time shows a very clear direction in the market. Now, here is the 2nd of February. Here is today, okay? We have only had upward price indications using this setup. Anybody that traded in any area of this chart, other than these 2 areas here, these 2 candlesticks here, anybody trading anywhere else will be in a profit. Okay, that's how accurate this setup is. Okay, whether you entered here or entered here or entered here, here, no matter where you entered, you would be in a profit at the moment. This is how important this setup is. Okay, this is taken from today. This is the price movement from the past 2 weeks. Okay, you can go on your charts, you can add the indications for yourselves, and you'll be able to see this. Okay, so we know we're looking at upward price movement. Why are we looking at an upward price movement? Because the price we can take any area as an example. So for example, if we look at this area here, why? Because the price is above the 75 bar EMA here, it's above, and we're between 50 and 75. So we know we're looking at upward price movement. Even here, ladies and gentlemen, where we don't get much upward price movement just yet, we know we're going to get upward price movement. Why? Because we're above the 50 and we're above our 75 bar EMA. And we can see, ladies and gentlemen, very, very clearly that it would have been a very successful trade. Even if we were trading here, okay, in which case for hours and hours and hours, the market would have been moving against us. Not by a lot, but it would have been moving against us. We know that it was a successful trade. We knew it was an upward trend because we're above the 50, below the 75, and we're also above the moving average as well. Okay, so this is step number one. We're looking at upward price movement. Step number two, let's measure the waves. Okay, so I've switched on to a different time frame here, and I'm measuring the price movement against us. So here I measured it 0.85. Measured this here 0.44. I measured this here 0.37. You'll notice these downward price movements, they're very similar. I mean, look, 0.44, 0.37, very, very similar. Even 0.85, not much of a difference either. Upward price movement, what's the measurement of this? What's the measurement of this? This is 0.26, this is 0.33. Again, it's the same, okay? It's more or less the same. So you can see the benefits here, because I know now, ladies and gentlemen, okay, I know, let's say this price movement hasn't happened yet. I know this is a retracement. I don't need anybody to tell me that we're retracing at the moment. I've measured the smallest downward price movement, okay? The smallest was 0.37, the largest was 0.85, so basically this one here, and the average was 0.55, okay? So I know at the moment we're retracing, okay? This is a retracement, ladies and gentlemen. We're retracing at the moment. This may end sometime soon. Maybe it's already ended as we've been speaking over the past 45 minutes. But I know using these measurements that there's a possibility it's going to decline up to here, or up to here, or up to here. I know this is my significant bracket here, ladies and gentlemen. Why? Because if we look at the traditional price movement, recent traditional price movement, this is the smallest, this has been the largest, and this is the average, okay? Now, let's say, ladies and gentlemen, we get that price movement. Let's draw a diagram here. So, you know, we got this upward price movement and then this downward price movement. So the upward price movement, this downward price movement, okay? Let's say we did go to that bracket. So we're stating it's in this bracket and the average is here. Let's say it declines to the average. So for example, here. Somebody says, how do we determine if it's going to be the largest, the smallest, or the average? To be honest, you take into consideration that as a whole bracket, so that whole range. What some people do though is they look at what's driving it downwards. If there's a strong reason to be driven downwards, then you can look at the largest. If there's not, you can look at the weakest or the average. But let's say we get to downward price movement. We know it's an upward trend. Why? Because here we can see indication of an upward trend. So we know it's an upward trend. We know it's retraced back to our bracket. So if we start to get a signal now that the price is going to increase, I know where it's going to go. Why? Because I know potentially where it's going to go, because this is the smallest, this is the largest, and this is the average. So I've got, for example, this 3 levels here to aim for, that the price potentially can do something like this, or do something like this, or do something like this. Now, some people have a high risk appetite, which is absolutely fine, in which case, you know, they may aim for this. Some people have a low risk appetite, in which case they may aim for the lowest. Some people have a very low risk appetite, which is absolutely fine. A lot of people do that. I've done it at times, in which case they'll say, I will look to aim for 75% of the lowest wave. So let's say the wave is going to do something like this. This is the lowest wave based on the lowest traditional wave. So they'll say, here is 75% of the low. So I will aim for here just to be safe and making sure I'm exiting before the end. And the next thing, ladies and gentlemen, is we also look at the breakouts. Okay. Now, of course, we want to speculate and make sure we have no conflicting signals. So this is indicating upward price movement. Okay. So when I go to measure on here on the smaller time frame, I'm only considering upward price movement. I'm not considering downward price movement. Why? Because I'm not going to be looking at conflicting signals. Why would I conflict myself? Here is indicating upwards. So here, I'm looking at the upward price movement. Yes, I'm saying to myself, you know, the price can decline somewhere down to here, but I'm only saying so I know when it goes to this area here, especially if it's going to go down to here or go to the average, I'm going to start to think, okay, somewhere now here, I may get a signal that the price is going to increase. Okay, how do I get that signal? Crossovers. These are the crossovers, ladies and gentlemen. Okay, we're ignoring downward crossovers. Why? Because our signals is upwards, so we don't want conflicting signals unless we have something to say to us, okay, there's going to be a change, we are going to get downward price movement, in which case that's a different scenario. We ignore and look at only upward price movement and upward crossovers. So where do we get upward crossovers? So here we had an upward crossover, here we had an upward crossover, and here we had an upward crossover. Here we also had an upward crossover, ladies and gentlemen, as well. This crossover, okay, the price moved in our favor. We got some minor price movement against us, nothing major. This is only a 5-minute time frame, so keep in mind that's just probably about 2 hours, nothing major. Next price movement moved in our favor. Next crossover moved in our favor again. Now the next crossover, the fourth one here, we don't know what happened next because it hasn't happened yet. Well, actually, this was actually done yesterday, the webinar. I put it together yesterday. So up at that point, we can't see on the chart what happened next. But it's all about looking at the signals and making sure they are not conflicting. So, ladies and gentlemen, that brings us to the end of today's webinar. We've looked at step by step how to consider identifying the next price movements, because it's not just about being able to determine the current price movement. We need to determine the next price movement as well. Now, we've looked at 3 steps. Number 1, finding out the sentiment, finding out who's controlling the market. We've looked at the 75 by EMA and the RSI on a period between 18 to 20. Next, we measured all the traditional price movement, recent traditional price movement. I'm not saying measure something from 3-4 months ago. Measure the latest price movement and look at the smallest, the largest, and the average. So you have that range like we did ourselves. The next thing is crossovers. We only look at bullish crossovers when the price is above the 70-month line and above the RSI. We only look at bearish crossovers when we're below. So these are the 3 steps, ladies and gentlemen. So that brings us to the end of today's webinar. If anybody has any questions, you can ask now, of course. I will leave the webinar open for a couple of moments, just if anybody has any questions.